All right, something just snapped in the silver market, and most people are looking in completely the wrong direction. In a matter of days, Western silver collapsed from roughly $121 an ounce down to about 84. That's a 37% wipeout, billions gone, fast. And while Western investors were panic selling, new data shows China quietly stepped in and started buying gold and silver aggressively. Not weeks ago, now. Both exchange pricing and trade flow data are confirming it at the same time. If you're holding silver right now, or if you're watching this market trying to understand what just happened, stay with me. Because I'm going to show you why this crash isn't saying what the headlines want you to believe, and how you can spot this exact pattern before it shows up again. Your job right now is to understand the mechanics behind this move, because the people who see this clearly are already positioning while everyone else is still reading yesterday's news. Before I explain what caused this, let me teach you something most people never actually learn about commodities. When you hear someone say silver price, you probably think there's one global price, right? There isn't. There's paper silver and there's physical silver, and they don't always tell the same story. Think of it like airline tickets during a storm. Online prices can crash when people cancel flights, even if the actual planes are still completely full. The digital price reflects panic, not capacity. In metals, it works the same way. Paper markets trade leverage, futures contracts, and promises to deliver. Physical markets trade actual bars, real delivery, and genuine demand from people who want to hold the metal. When those two markets disconnect, when paper drops and physical stays firm, that's not just market noise, that's information. And right now, that gap between paper and physical is absolutely screaming. So what does that tell us? It tells us we need to watch both prices, not just one. Because when they move together, that's normal market function. When they split apart, something structural is happening under the surface. And what we're seeing right now is one of the widest disconnects in years. If this is making sense so far, drop a comment below and let me know where you're watching from, because I want to know who's paying attention to this in real time. Now here's what's actually happening. Let me break down the sequence of events step by step. The primary driver of this crash wasn't collapsing demand. It wasn't a fundamental shift in silver's value. It was forced selling. Western markets, especially in precious metals, are heavily leveraged. Funds borrow money to amplify their positions, and when prices start falling fast, margin calls kick in. Those are automatic triggers that say, hey, you don't have enough cash to support your position anymore. Sell now or we'll sell for you. And here's the thing, when that happens, funds have to sell. Not because they suddenly think silver is worthless, not because they want to, but because they're forced to by the mechanics of leverage. That forced selling hits the futures markets first. Futures are where the big money moves fast, and when futures drop, they drag spot prices lower with them. Suddenly, everyone watching sees silver plummeting and thinks, oh no, something fundamental just broke. But did it? Here's the secondary confirmation that actually matters. While Western spot silver dropped toward $85, Shanghai silver, the physical market in China, stayed near $122. Let me say that again. 122 versus 85. That's over a 40% premium for physical metal in Asia. If this were a real oversupply story, if demand had actually collapsed, you wouldn't see that premium. Physical buyers would step away. They'd wait for lower prices. Instead, they leaned in. They started buying more. So when forced paper selling hits Western exchanges, here's the cascade. Prices fall. That triggers more liquidations because more positions hit their margin thresholds. Liquidations accelerate the selling. Headlines get scary. Media runs stories about silver crashing. And meanwhile, quietly, entities with long-time horizons look at that discount between paper and physical and say, we'll take delivery, thank you very much. China isn't guessing here. They're not speculating. They're converting paper weakness into real metal. And I want you to understand the strategy behind that. When you can buy silver in New York for 85 and it's worth 122 in Shanghai, that's not a small edge. That's a massive arbitrage opportunity. You buy the paper contract cheap, take physical delivery, and you've instantly locked in a premium. Now, most retail investors can't do that at scale. But sovereign entities, large funds, they absolutely can, and the data we're seeing suggests that's exactly what's happening. Now, let me show you what most people are completely missing. That premium staying above 25%, that's not a side detail. That's the signal. It tells you the sell-off was mechanical, not fundamental. If the fundamental value of silver had actually changed, if global demand had collapsed, that premium would disappear. Buyers in Shanghai would say, why am I paying 122 when everyone thinks it's worth 85? But they're not saying that. They're paying the premium anyway, because they understand that the Western price is being driven by forced liquidations, not by actual supply and demand for physical metal. The physical market is telling you the real story. The paper market is just showing you who's getting liquidated. But here's the part that should really make you pay attention. This isn't the first time we've seen this exact playbook. This is the exact same pattern that showed up before, and when you recognize it, you start to see the market differently. Let me take you back. In 2008, during the global financial crisis, precious metals got absolutely crushed. Gold, silver, everything sold off hard. But it wasn't because metals were suddenly worthless. It was because everything was being sold to raise cash. Banks needed liquidity. Funds needed to meet margin calls. So they sold whatever they could sell fast. And metals were liquid, so they got hit. But what happened next? Strong hands, the people who understood the difference between price and value, they accumulated quietly during that panic. Within months, metals started recovering. By 2011, gold and silver had both staged massive rallies. Or take 2020. Remember March 2020? COVID panic hit. Markets froze. Silver futures collapsed. I'm talking 20% drops in days. And at the exact same time, physical premiums exploded. You couldn't find silver coins or bars at anywhere near spot price. Dealers were charging $5, $10, $15 over spot just to get physical metal. Why? Because futures were being sold by funds that needed cash. But actual people who wanted to own silver were buying everything they could find. And what happened? Within months, silver staged a violent rebound. It went from around $12 in March to nearly $30 by August. That's a 150% move in 5 months. Every time paper and physical diverge this sharply, it marks a transition, not an ending. The selling exhausts itself. Volatility spikes. Physical demand absorbs the supply. And then price snaps back faster than most people expect. The larger pattern here is consistent. Forced selling creates opportunity for those who can recognize what's actually happening. When you zoom out and look at the history, you start to see it. The crashes aren't random. They're mechanical. And the recoveries aren't lucky. They're predictable based on understanding the structure of the market. Now, before we go further, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could prices stay volatile for a while? Absolutely. Could silver briefly dip below $80? Sure, it's possible. Markets overshoot all the time. And no, this doesn't mean markets are rigged in some cartoonish conspiracy theory way. I'm not here to tell you there's some evil cabal controlling prices from a secret room. Markets are mechanical systems under stress. When you add leverage, forced selling, and rapid price moves, you get cascades. That's not manipulation. That's mechanics. Could this be different than 2008 or 2020? Maybe. Past performance doesn't guarantee future results, and anyone who tells you otherwise is lying to you. Here's the thing, though. It doesn't actually matter whether you think someone's intentionally pushing prices around. The mechanics are what matter. The data is what matters. Focus on what you can control. You can't control whether hedge funds get margin called. You can't control whether China keeps buying, but you can watch the data. You can watch spreads between paper and physical. You can watch delivery demand. You can watch who's buying when prices fall. That's how you stay grounded when emotions are flying and headlines are screaming. Don't get caught up in the drama. Watch the mechanics. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. If you're someone who's shaken right now, if you watched silver drop 37% and you're feeling that pit in your stomach, that reaction makes complete sense. Volatility hurts. Seeing your position down that much is painful. For you, the lesson here is understanding whether selling pressure is emotional or structural before you act. Because if you sell into a mechanical liquidation event, you're often selling at exactly the wrong time. You're giving your metal to the people who understand what's happening. Now, that doesn't mean you should never sell. If your risk tolerance has changed, if you can't handle this volatility, that's a legitimate reason to adjust your position. But do it because of your situation, not because of price panic. Understand what you're reacting to. If you're skeptical, if you're watching this and thinking, this all sounds like convenient narrative building, maybe it's just coincidence, that's actually healthy. Your edge is waiting for confirmation, not chasing stories. So here's what I'd tell you. Don't take my word for it. Go look at the Shanghai premium yourself. Check the data. Watch whether physical demand stays strong or collapses. Give it a week. If I'm right, that premium stays elevated and Western prices start stabilizing. If I'm wrong, the premium collapses and everything converges lower. The data will tell you. Your skepticism keeps you from getting caught in hype, and that's valuable. Just make sure you're also not letting skepticism keep you from seeing real patterns when they appear. And if you're already experienced, if you're someone who watches spreads and premiums and understands market structure, you know exactly why this moment matters. You've probably already been watching this develop. For you, the opportunity is in the details. It's in the timing of when that premium starts to close. It's in watching whether Shanghai holds above 115 or starts to crack. It's in the volume data and the delivery requests. You're not trading the story, you're trading the mechanics. And you know that these disconnects don't last forever. When they close, they usually close fast. For all of you, regardless of where you are, the universal principle is the same. Price alone is never the full signal. Context is everything. You need to know why price is moving, not just that it's moving. A 37% drop because demand collapsed is very different from a 37% drop because leveraged funds got forced out. Same price action, completely different meaning. So here's what I want you to answer in the comments. Where are you in this? Are you holding? Are you watching? Did you buy the dip? Or are you waiting? Because I want to understand who's in this community and how you're thinking about this moment. So here's where I stand personally. I'm not panicking and I'm not blindly bullish either. I'm observant. Let me tell you what I'm watching. First, I'm watching whether $80 to $85 holds in Western markets. If we break convincingly below 80, that changes the technical picture and suggests maybe this has further to fall. But if we hold that range and start building a base, that would indicate the forced selling is exhausting itself. Second, I'm watching Shanghai staying above 115. If that premium holds, it confirms that physical demand hasn't collapsed. If Shanghai starts dropping toward Western prices, that tells me either demand is weakening or supply is flooding in. Third, I'm monitoring whether that premium stays elevated through next week. Premiums can spike for a day or two on dislocations, but when they hold for a week, 2 weeks, that's telling you something structural about the market. Based on my analysis, this move was mechanical and technical, not fundamental. The fundamental picture for silver hasn't suddenly changed. Industrial demand is still there. Solar panel production still needs silver. Electronics manufacturing still needs silver. The supply deficit that existed last month still exists this month. What changed was that leveraged positions got flushed out of the Western paper markets. That's a liquidity event, not a value event. If history rhymes, and I think it often does, forced selling clears, strong hands accumulate during the dip, and silver doesn't stay cheap for long. The move that follows these kinds of liquidation events can be sharp and fast because once the selling pressure is gone, there's often not much supply willing to sell at these levels. Now, I need to be clear about something. I'm not a financial advisor. This is not financial advice. I'm sharing my analysis, my interpretation of what's happening, but you need to do your own research. You need to make your own decisions based on your own situation, your own risk tolerance, your own time horizon. What makes sense for me might not make sense for you. So take this as education, as a framework for thinking, not as a recommendation to buy or sell anything. If you made it this far, you're part of a small group that actually wants to understand markets instead of just reacting to them. That mentality, that willingness to dig deeper and look past the headlines, that's going to serve you well, whether we're talking about silver or any other market. The people who win long-term are the ones who understand the structure, who can separate signal from noise, who know when price is telling you something real and when it's just reflecting mechanical pressure. Keep that mindset, keep learning, keep questioning, and stay sharp out there.